Good morning. So it's a healthcare conference, so we're going to focus on healthcare. But before handing over to Fabrice, who is going to deep dive on the subject, I will just give you a very quick overview of our company, Aevis Victoria, which is the listed entity, and which is not only about healthcare, just to have a helicopter view on the group. So, seen from the outside, it seems a bit complicated sometimes, but it's pretty simple at the end of the day. We are an investment company, and the only thing we do is services for the people, services around the people. So whether it's hospitals in our healthcare division, which is the biggest part of the group, whether it's hotels in the hospitality division, or whether it's infrastructure needed for those two areas. So our hotel real estate portfolio, SHP, or our healthcare portfolio, real estate portfolio, Infracore. At the end of the day, all this is just focused on one thing, services to the people, and this is what we understand, and we'll never do anything else. Now the question, is this creating value? The answer is clearly yes. Over the past 15 years, our value has increased 18-fold, always with the same philosophy, very entrepreneurial investment approach, and strong focus and a long-term creation for all stakeholders. What you see actually is that over time, this has been recognized by the financial markets. Basically, the market cap has evolved broadly in line with the development of the NAV. This was until recently, where there is some dislocation. Now, for some time, there is a substantial discount, close to 50% versus the share price. This is related to several points, namely the fact that we were excluded from an ESG fund and we made a pause for the dividend, which will resume again. These are the main reason for that. But now, with this in mind, I would like to hand over to Fabrice, who will going to deep dive in the segment of healthcare.
Thank you, Michel. Good morning, everyone. It's a great pleasure for me speaking about value creation in healthcare. As you all know, our industry faces many challenges with escalating healthcare costs, with rising chronic diseases, with aging population, and we feel the pressure like everyone. But we have a very strong vision. And this vision is really about value creation, create value for our customers, patients, create value for our company, obviously, and create even value for the Swiss healthcare system. Let's start with our track record over the 20 last years. Very impressive growth by acquisition, but also organic growth. And it's really about our ability to integrate new companies, new hospitals in a very synergetic way. And with this vision, this very strong vision, we were able to cover the whole country, every linguistic regions across 16 cantons. Our organization, we have 6 regions that you are seeing now, and the blue ones are the so-called integrated care regions. Is really part of our strategy to develop these integrated care regions, 19 hospitals, 70 outpatient centers. It's the recent evolution of the group, and with around 1 billion revenue, we are best in class with EBITDA and EBITDA for our hospitals. But you are seeing here a dilution of our margin because of the recent acquisition, and Michel will talk about this effect a bit later. Yes, that's our vision. From a sick care system to a real healthcare system. It's nothing else than from, let's say, a fee-for-service system to a value-based care system. Everybody talked about this vision, but not so many are able to bring it to reality. That's our vision, and because we really think that this system cannot give the answers that we need for the future of our healthcare, and it's really about continuum of care, from prevention to rehabilitation, and it's about our ability to cover all the possible customer or patient journeys in a very efficient way. And for us, it's really about patient experience, health outcomes, and cost effectiveness. And we do really believe that it's only possible in a combination with insurance offering that you take care of, for which you take the whole responsibility, in other words, with a capitation model. And what inspired us was the Kaiser Permanente. And with very striking facts and figures, let's look at hospital stays. When you look at this, you realize we have 14 more times hospital stays in Switzerland than in the US. And you can argue about the differences between the two systems, both systems, but you only can explain it with false incentive. And we do really believe that in a system which it seems that only the hospital stay are important, that you need another approach. You need to think about smaller intervention. You need to think about hospitalization at home. We need to think about cost effectiveness. And it was with this motivation that we decided to open integrated care regions. We started in Le Réseau de l'Arc in this region here with Saint-Imier-Moutier. Then we could open Ticino in the Italian part of Switzerland, and this year Zofingen. And we will open next year a new region around the city of Bern, a very interesting region for us. And our intention, our goal is to cover the whole country. And something very interesting for us and is that the fact that we have to be very agile and to understand the differences, because it's not a copy-paste project. You have to adapt, you have to find the right answer, and we can proudly say that we were able to do that. And we see it with the premiums here of our insurance model called Viva. And you see we are very, very well positioned with the best prices in almost every region. But it's only one part of the story. The other part of the story is that we want to generate value, and this is our business model. And you see that we are seeing it now here that we are around 10,000 members. We will be at the break-even point. We are currently able to double the members in the last year, and you will double it with the fourth region next year. That is to say, we are really strictly following the business case that we had in mind 4 years ago, and we are very proud of it, and we will generate value for us and value for our customers. Maybe a reflection about what we are doing. And you see here in this maybe a bit complicated vision that we really want to cover every aspect of the patient journey. And you can also see that if you are looking at our Aevis footprint or for a Swiss Medical Network footprint, we are not everywhere. And that's the reason why we need strategic collaborations. We need new collaborations, even local ones. And we were very proud to convince Visana to join us, and we were able with Visana to offer an insurance product, and we take the whole responsibility as healthcare provider. We take the whole responsibility, even the financial one, and it brings you to other reflections, to overthinking, and yeah, I think with the time we are seeing that we have so many possibilities. For example, the next speaker will speak about pharmacy retail. It's something very interesting for us. In the Réseau de l'Arc, we were able, with our own pharmacy, to test new models, and it's very efficient. With Hospital at Home, we could reduce the length of hospital stays. But it's only possible in a capitation model, because in a fee-for-service model, you would lose money. And that's the reason why all the companies which are trying to copy what we are doing are not following the right path in our view, because they don't understand that only with the combination with the capitation model, we will able to deliver value. And so we can think of many possible strategic options, and we are feeling now that there is a very strong commitment from many players in this industry to join us and to bring this vision to the next step. I would like to speak shortly about Infracore. Infracore is a real estate company focused on the healthcare offering, hospitals, clinics, etc., with a very impressive track record. And why I'm doing so? Because that's our partnership with Medical Property Trust, and maybe some of you have read that we were looking for new solutions from capital increase to an IPO, and the reason why is that we really think that there is a very strong market opportunity, a strong sale and leaseback opportunity, because on one side of the challenging financial conditions, the eviction or the disappearance of Credit Suisse has changed a lot of things in Switzerland. There is a credit crunch. There is also another reality. The credibility was eroded with the Wetzikon case in Switzerland, and we really think that there was, in fact it's a slide that we are showing for many months now, and it was the perfect timing. Yesterday we could communicate that we will acquire the real estate of Hospital Organ, in the only hospital in that side of the Zurich Lake, and this is a very strong opportunity, the first step for us, and we are very excited about our future, even with these new opportunities. Thank you, and I hand over for the financial figures to you, Michel. Thank you.
Yeah. Okay, I will make it very quick, because I think then you will start the Q&A, right? So just a quick snapshot on the financials. We just published 3 days ago. This is the healthcare division. So you see a good growth, 22% growth, obviously influenced by 2 acquisitions. On organic basis, it's 2% growth. And the second message is the level of margins. You see healthy EBITDA margin. EBITDA is before rent. That's a key indicator in the industry. So 15.9%. You see it's a decline year on year. It was 16.6% last year. But here 2 remarks. The first reason is that it's related, as you can see on the next slide, to the dilution effect from these 2 acquisitions. So on the upper part, you see the underlying business. So you see that margins are still moving up from 16.6 to 17.2%. However, including 2 acquisitions, which have in average 9% EBITDA margin, obviously you have a strong dilution. This is good news, because we see that margins were down for good reasons, because acquiring companies or companies that we buy at a cheap price, we reposition, and it's a good way to create value. And the reason I'm saying that is that this is what we've done over the past 20 years. So here you see on this curve all the hospitals of the group, and basically all the green dots are hospitals with EBITDA margins above 20%. The red ones are below 10%. And every single point you see on this curve, every single green point was at some stage down the curve and moved up step by step. Some of them took 3 years, some of them took 7 years, the others 5 years. Every hospital is different. But what we can say now is that after 20 years of experience, we have a real proven playbook that works, and it's always the same thing, and all of those dots are moving up, and this is why we are very, very confident that the red ones and the yellow ones will continue to move up every day, every year. If I put that in perspective, this is a picture of the whole industry. You see that on the basis of 24 figures, because we don't have the other figures for the other hospitals. The Swiss hospitals, in average, are at 5%. Here's London, our friendly competitor, 13.6. We are at 16.6. Actually, we went up to 17.2 in 25, if we exclude this dilution effect. And if we look at just the hospitals, which is the right way to do, excluding ambulatory service, which the others don't have, so we can compare apple with apples, we are at 19% in 24 and 19.7% in 25 versus the other players. Now, the key message of this slide is not to show that we are at the highest level in the industry, even though I'm not unhappy to mention it. But the key message of this slide is to show that even though we are at the top up there, it's not the end of the story. Because as you've seen on the previous slide, a big portion of this portfolio is still with unmature hospitals, which have margins below 10%. So you can see this level of 19.7% will continue to gradually increase year after year because of the ramp up. And I just finished with this one word on the guidance we've just given. So as a model, we are growing 2 to 3% per annum. It could be more, but let's stick to 2 to 3%. And if we start with the 25 figures, 15.9% EBITDA margin, we have a target for 26, so this year, of 20.5%. And then midterm, 20, we don't see it because there is a timer on it, or you see it, 23%. As a midterm. Now, how we get there, between 25 and 26, there are a lot of moving parts going in the right direction. Electricity prices will be much lower for us because we are out of a hedging contract, so we're back to the spot prices. We'll save at least 2 million here. We'll have a lot of cost-cutting programs whose costs were incurred in 25, but the benefits will be seen in 26. And then the third driver, the ramp-up of hospitals. This is always the key driver for our group. After 26, it will be the same thing. The ramp-up of under-profitable hospitals is the main driver. And on top of that, you will see the impact of what Fabrice described before, the integrated care, which is very, very powerful in terms of profitability improvements. And finally, some M&A possibility. This brings us to the 23% for the group level on a midterm basis. With this, Fabrice and myself are very happy to answer your questions, Bjorn, and also to questions from the audience.